Alrighty, welcome back everyone. Today we're going to be looking at Google stock. Now Google has had quite the run in the last couple of years, and it almost makes it look like it's sort of run away out of investors' reach. However, we all do know that the share price is not everything, and it very well could have grown so much because the underlying business really did that well. So let's go ahead and take a look at Google then. First thing I like to look at is the price to earnings ratio, and I typically like to see this 20 or under. Now Google is currently at a 23 PE ratio. However, we do need to keep in mind that if the company has pretty good growth, a higher PE ratio can be justified. And Google's been growing quite well lately. Speaking of growth, let's go ahead and take a look at their revenue, free cash flow, and net income growth. And as you can see here, over the last 5 years, Google has had really impressive growth. Revenue went from 110 billion to 257 billion. That's insane. And net income went from about 12 billion to 76 billion. Free cash flow grew from 23.9 billion to 67 billion. I don't think I need to explain that these are really good growth metrics for a company that's already so large. Next, we'll go ahead and take a look at Google's debt. Now, I like to look at the average of their last 5 years of free cash flow and then multiply that by 3. In this case, it's 30.5 billion times 3, and it comes out to about 112 billion. And we want to see that the long-term liabilities are under that 5-year average free cash flow multiplied by 3. In this case, their long-term liabilities are only 14.8 billion. They can easily cover their long-term liabilities. And the other thing I like to look at is current ratio. And that's basically saying, can their current assets cover their current liabilities? So Google's current assets are about 188 billion and current liabilities are about 64 billion. Now remember, any current ratio over 1 means that they can cover all the liabilities, but I typically like to see the number closer to 2. In Google's case, it's closer to 3. Google's numbers are looking really good so far. Great growth, they can handle their debt easily, and you can certainly justify the PE ratio they have. It's only a little over 20, and they've had pretty good growth in the last 5 years. And speaking of growth, we now need to move over to our DCF model to get a fair value for this company. However, we need to figure out what growth rate we want to use for the revenue, and keep in mind that we also want to be a little conservative with that number. Now, I did run a compound annual growth rate on the last 5 years of their revenue, and it was about 18.3%. So they grew on an average of about 18% each year. I also took a look at some of the analyst estimates, and the average for the year 2022 was about 18%. And then for 2023, about 15%. Keeping all these numbers in mind, I thought that 10% revenue growth was more than conservative considering how well Google has been doing. Okay, so we are here inside the DCF model. We grew the revenue by 10% out to the year 2026, which put it to about 415 billion. Next, we applied a free cash flow margin. For anyone wondering, you can just get this margin by dividing free cash flow by revenue growth. I did this for the last 5 years, and the average came out to about 21.3%. The majority of those numbers were easily over 20%, so I thought that going with 18% seemed pretty fair and still keeping conservative. We apply that percentage to all of the projected revenues. We also got a terminal value for projected free cash flow of about 1.7 billion, and we get that terminal value, of course, by taking weighted average cost of capital into account, as well as a perpetual growth rate for the life of the company after these projected years, which I always go with 2.5%. We then discount all those numbers with my desired rate of return, which I like using 12%. After adding all those figures up and dividing by the shares outstanding count, you will get your intrinsic value, which came to 3,432.5, or let's just call it a flat 3,432 for your fair value. So I'd argue that I used pretty conservative metrics for this DCF considering how Google has been doing. And I've got to be honest, in a stock market where we've had a lot of overvalued companies, I was surprised with this one. For some reason I thought this was going to come out as overvalued, but I was very wrong. At the time of this recording, the share price is around 2,600, and the fair value I got is around 3,400. So according to the model, this is definitely undervalued. So that's pretty much going to wrap up the video, everyone. If you enjoyed this video, go ahead and give the channel a sub and give the video a thumbs up. And with that, you guys have a great day.